Hey guys, it's Alex, otherwise known as the Sleepy Neko from the Honeypot server. I wanted to start off by giving thanks to everyone newly that has joined our Discord group wanting to learn the various fundamentals of the stock market. I also want to give thanks to all of our previous members that have been guiding along our new members into the various resources for them to understand. Also, thank you for our Patreon members that have been supporting us on getting the early stock alerts. So you guys have been making sure we could continue along with this aspiration of making sure you guys get these videos on time. I know this video took a little bit longer to make as it is more anticipated and options is a high risk, high reward strategy. So I wanted to continue with our disclaimer that all this information on this video is not to be considered financial advice. It is solely for you to learn and understand the technical analysis of the stock trading and the market. And now we will actually begin with our lesson of options. But first, I wanted to start off by breaking down the graph, reading the actual analysis of the stock, which we will be looking at here on the Webull platform. For you mobile users, I will have this display right here on the right hand side showing you how to move along to actually look at the option chain, which is a list of different prices that we will be purchasing contracts at. As we can see, QS has been on an uptrend, and I clearly have broken it down right here as it reached this high price point of 87.50 and has fallen back down into an area of consolidation where it can't break through of 73 bucks and 73 cents. We can see this uptrend that it started right here at 20 bucks and continuously done it over the course of this month. Through our indicators, we could see that it was overbought when it had reached 87.50 and it had a cool down on the RSI. Also, we could see on the ADX that when it started this new uptrend, it had done a peaking corner, went uptrending, and I was showing a peaking corner which could potentially show that it might downtrend to consolidate again. We also see that the MACD had showed us an opportunity to buy, which is right here at this red candle, which was 62 cents and almost 35 cents, and people scalped for some profits of almost 10 bucks right here. The KDJ supported this buy opportunity by the KDJ purple line going underneath the EMA average lines. Also, we can see that the MACD is above the volume average. If you don't understand these indicators and how I'm expressing them, please go back over our indicator videos as I do break down the various fundamentals of this. Now that we know that there is a potential growth of almost $10, $13 for QS to go up back to a price point of 87.50, we want to make sure we understand options before we make an option call or option put of maybe it falling back down into an area consolidation of, let's say, 59 bucks. So what are options? And we will start off with the contract. A contract is an agreement but not obligation between a seller and buyer to exchange one contract. One contract equals 100 shares at the specific price market. So let's say, for example, the contract we're buying it at is 74 bucks. This is also known as the strike price. And this is before an expiration date because each contract has an expiration date when we purchase it. So there are two exchange types. What are the exchange types? Well, there's a put option, which is selling 100 shares at the strike price, which is a bearish action. You are expecting the price to fall in exchange for a premium from the buyer. While a call option is buying 100 shares at the strike price, which is a bullish action, expecting the price to rise in exchange for paying up a premium to the seller. Now, when you buy or sell these contracts, there are expiration dates. And when you purchase these contracts, there are specific timeframes you can make sure that these expiration dates go to. They could go out to days, weeks, and months. Sometimes when they're for months, they could go out into the next year. So for example, today is December 20th, 2020. I could buy a contract that goes out in expiration in January 20th, 2020, which now would actually not be 2020, it would be 2021. So the further the contract, the more expensive the premium you would have to pay or the premium you would receive as a seller. So remember, you pay up as the buyer because you're trying to say that the stock will go up and you're trying to purchase 100 shares at a specific price point. And also, if you are selling the 100 shares, you're expecting the stock to go down and you're trying to kind of consolidate an area of profit when you do. So when you're holding a contract, on expiration date. So let's say I made that purchase of the contract December 20th, 2020, and now it's January 20th, 2021. On expiration, the market will fulfill an order for you as the buyer to purchase 100 shares at the strike price, or for you as a seller to give up your 100 shares at the strike price. Remember, one contract equals 100 shares. So when you pay up your premium or you receive your premium, depending if you're a buyer or seller, this amount could be returned back to you because the market holds on to that premium because you paid up for it or you're selling it. You could simply sell or buy back the contract, depending if you're the buyer or seller, before the expiration date. This is why options are not obligations. They are simply short-term agreements, and your premiums are held as an influence by factors known as the Greeks. So I wanted to explain the Greeks are various terminologies and variables that change our value of our contract, and mostly which will change our premium, which is what the money we put up or the amount of premium we ended up receiving from the buyer. So the Greeks are numeric values we multiply by 100. Each contract is 100 shares. As a reminder, this is why we multiply by 100 that imply the profitability of a contract. Key important ones that we will be discussing today are delta, gamma, vega, implied volatility, and theta. Delta, to start off, implies the option price going either up or down, and depending if it's for a call, this value will go from 0 to 1, and if it's for a put, this value will go for 0 to negative 1. The more for a call option, the more higher it goes towards 1, the more premium we will receive, and the more it would stack up to our premium. Now, if it's a put, the more it goes into negative because we are saying that the stock will go down, the more premium will increase as the stock goes down. Delta is an added or subtracted from our premium based on these numeric values. Gamma, like it goes closely with delta, changes on the relative based on change the relative delta based on the stock moving up or down. Gamma will be then either subtracted or added from our delta, which will then in turn affect our premium overall. So implied volatility is pretty easy to understand. It is the expectancy of the stock moving up or down. It doesn't tell us if it's going to be a bearish or bullish movement. It's just saying that there is high expectancy that the price would change. Higher volatility will basically say that the stock will move drastically in price. Lower volatility will mean that the price is expected to stay stagnant because it might be just consolidating. So Vega moves closely with high implied volatility and low implied volatility. So Vega is the option's value of change based on that volatility, in which is either subtracted or added to our premium. Now, lastly, we are going over theta. Theta is time decay on an options contract. As each day goes by and you hold this contract before the expiration date, a percentage based on theta will be subtracted from our premium. Some forms of strategy, mostly put strategies, take theta to their advantage because they want the stock to go down and they want the premium to keep obviously increasing into their side. But there is also no workaround on theta, so don't expect to understand, oh, this is when theta ate out my contract. It's just not. It's not something we could ever control. It is just something that always happens, and we never know when. So as we could see here on QS, that there is potential growth of almost $10 for us to profit, and there's also potential downside of us of the stock going almost down $20 if it goes to around the price point of $59. So to start off, we will go to option chain, which is basically the various puts and calls that we could end up purchasing these contracts at. When we go right here on this option form, on your mobile device, you would see it at the very bottom, right? You would see options. If you click on it, you would see this thing what you call option chain. As you can see right here, we have various dates, which are the expiration dates in which these contracts will be fulfilled. Um, and we would be here clicking on this. For now, we would start off on December 24th, which would be an expiration 4 days from now. Since we would have to scroll down and see that QS is right now current price of 73.73, we would be saying if we're doing a call, we're seeing that the price is going up. Um, So we're gonna purchase this call contract, and we'll make sure it's just one at limit, which is at this price point of 74. This uh, 2.80 is basically how much premium we would end up putting up to hold this contract. And then we would have various forms of delta right here, gamma, theta, vega, break even point, in the money, out the money, implied volatility. If you don't have these options, you go click right here and then scroll down, and then you would see delta, gamma, theta, vega, implied volatility, break even point, in the money, out the money. So right here for a call, we're buying one call of QS at 74. If we let this option contract expire, so right now is December 20th. If we let this expire on December 24th, we would purchase 100 shares at the price point of 74. So they would take out 7,400 out of our account and basically purchase 100 shares. We normally would not want to have the contracts expire. We want to sell these contracts before expiration so we could keep the pre or get back our premium that we put up on top of the gains that we had made off of all these Greeks in numeric values that had helped us as the stock went up. If the stock goes down, we could obviously sell the call by pressing sell and then sell one quantity, but right now we're just doing buy. You would only sell your contract when you're almost close to expiration and you made enough profit that you're comfortable with, or you have to sell for a loss at times, and that does happen with options because, like I said, these Greeks numerical values have implied values to your premium, and it can make or break your gains. So right here, when we look at the $74 call at the strike of 280, which is 280, I would put up front as a premium. Implied volatility right now is 123 and 70% point decimal. This is actually pretty high and it's almost close to changing 1 more percent. So if this were to go 124, our Vega would end up adding, if we move this decimal 2 to the right, because we're multiplying everything by 100. Remember all these variables from these Greeks, from delta, gamma, theta, and vega, we multiply it by 100. It would add $3.43 to our premium as long as the stock keeps going up by each percent. Um, then for our data, it's a negative value because this is time decay. As we hold the contract each day, data will end up reducing our contract by almost $42.46. The reason why it's so high is because we are close to expiration. We are 4 days close to expiration. The closer you are to expiration, the more higher data goes. The data ends up changing. So you always want to get contracts that are maybe 1 month, 1 week further apart. So data doesn't really eat your contract too much. Those are just my general advice. For gamma, like we said, gamma moves and changes delta. So if the price goes up by $1, this would end up moving or goes down $1, this could either subtract or add $3.74 from our delta, and then this would affect our premium. So if we were to go down, we would subtract $3.74. This would kind of roughly put it at almost uh, $47, and that would end up basically subtracting from our amount if the strike and if the price of QS keeps going down and does not pass the break even point or even this price point is 74. This is why there's a break even point saying if we're trying to profit the most with all this time decay and all these variables, we need the price to go to 77 bucks and 60 cents. Or if we're just trying to do some quick scalping, we could just try and make some profits passing the 74. This break even point does change as the stock moves, so do keep that in mind. So right here, delta, as we said, gamma could either end up adding $3.74 to our delta. It could end up changing either up or down to basically 50, 55 bucks, close enough. If we were to do the calculations by 100 and add and subtract, or it would go down to 47. And this could either add or subtract as each dollar moves up onto our contract. So this is a various understanding of us making sure we do a proper call. Now for a put, the variables are a little bit more different. Let's say I'm saying a put, I'm buying a put, saying that the stock would go down a little bit lower than 73 bucks. It would go, let's say, right here to 72.50. Or even like I was saying in my analysis, it could go back almost to like a $59 price range. So I would do this $59 put, and I would do it as a buy. I would do a contract of one, and you're basically saying the amount I would put up for my premium, which is the bidding point, would be 100 bucks. The max loss I could do is 100 bucks, and the max profit I could do is 5,800 if it keeps going down from the price point of 73 bucks. So this is why puts and calls could go both ways for your profiting. And now we could see the variables right here of delta being negative. Why is it negative? Because the more it keeps going down, this variable, the more our premium will increase because we're saying that the stock will go down. So that's pretty much what we want. And remember that data decay will also eat at our contract, and that can sometimes help in some put strategies, but I will not go along those explaining those strategies because it takes a little bit more time. And currently, Webull does not have level 3 option trading until next year, so I hope you guys are a little bit more patient with the next upcoming video. But we will be doing some discussions as we go along. Well, to continue, we can see this implied volatility right here is 203, and it's close to actually maybe going back to 2000, 202. So this would actually, our Vega would end up either adding or subtracting, depending if it goes up a decimal point or subtracting a decimal point to our premium of almost a dollar 97 cents to our $100 amount as the stock moves by the decimal values, which is based on the price. Then our theta will always end up eating 40 bucks as we hold this contract because remember it's close to expiration. Our gamma right here would end up adding $1.31 to our delta as our premium as the stock keeps going down. So this is how you end up understanding that the delta will keep on adding to our premium almost about 14 bucks and 64, and that's without the gamma being added of a dollar. So it could be actually like 15 bucks and 95 cents that could be added to our premium or even subtracted because if this stock doesn't keeps going up from 73 bucks, I'm basically losing money and I would have to sell this put. And let's say your call, same thing, you would end up having to sell your call. That is how you enter and exit out these trades and make sure that your options are never actually fulfilled. Because if you, let's say you fulfill these contracts, you're basically buying 100 shares at 73 bucks, or you're buying 100 shares at 59 bucks, which maybe in this case, if you're buying 100 shares as a put at 59, that's actually profitable because there's potential growth of this going all the way to 80. So this is why there's various strategies of understanding when to put in call. But for now, we're just basically going the basis of you understanding the variables and how it affects your contract. Later on, we will actually be making some live purchases of calls and puts for you guys to see how we move along. I know this video was very brief, but it was just to break down the various fundamentals of you guys about option tradings and how it can be a potential strategy for you guys. I would thank you all for being patient on this video, and we have much more to come in the future. Thank you guys, and I'm out.